Hey everyone, me Kevin here. It is the middle of the night. It is still technically June 30th, so that 40% off coupon code for the programs down below is still active, linked down below. And folks, I gotta give you a market update. Since I'm not going to be available to give you a market update in the morning, I'm going to be at Patrick Bet-David's podcast, which you should watch. 9 a.m. Eastern time, 6 a.m. Pacific time, I will be live with Patrick Bet-David, so be there or be square. But folks, I wanna give you a little bit of a market update. I think we need to move heavily, and this is my belief, this is not financial advice, so don't sue me, bro, if you lose lots of money doing this. I think seriously, we need to consider long shares of growth stocks. Now, why am I saying that? Why do I think we need to go long on shares and not options of growth stocks? It's because, folks, the numbers are shifting again. We just got PMI reports from China, Korea, and Japan. And you might be wondering, Kevin, who cares? Like, most of us are in the United States. Like, why do we care about growth numbers out there from companies? Because remember, a PMI reading is essentially a company responding to a survey every single month with an answer as to their business is slowing down, flattening, or being it's flat month over month, or it's growing. And more companies are saying their business is flat or slowing down from the beginning of the year. Now, this is Asia. Asia is a few months ahead of us. So really, when you look at Asian data, you actually can use Asia as a way to predict what could happen in the United States if we follow a similar pattern. They take care of COVID long before us. They recover sooner. They get a boom sooner. They get a slowdown sooner. It's a little bit of an omen for the United States. And guess what Bloomberg says is doing not so hot in, for example, Japan or China right now? Value, like value stocks or cyclical stocks or recovery stocks, things that looked like they were beaten down and cheap. This is what Cathie Wood calls the value trap style stocks, where potentially you could be getting into something that's higher debt and expected to have lower growth in the future and potentially ends up getting squeezed out of business in the future in favor of innovative companies. Now, in fairness, we should be fully transparent here. Cathie Wood is extremely bullish on innovative stocks, and it's not a surprise that she would say something bad about recoveries or potential value companies that end up being value traps. This is not a surprise to hear that from Cathie Wood. But what is something that we should be prepared for is, what if we do see a slowdown in economic growth more substantially than we think? How do we position our investment portfolios? How do we position ourselves just in general? Well, one thing that I'm concerned about is if we see less growth in the markets, I have a slight concern that, wait a minute, what if the crazy, growth that fueled crypto rallies doesn't come back, at least not soon? What if instead of crypto going from 34 back to 64 and then to 100,000, Bitcoin goes from 34,000 to 38,000 and it just sits here for the rest of the year? It's entirely possible that Bitcoin does that, and that would obviously affect all of the other cryptos. Now, why would I say that? Because one of the things that led to this euphoric rally that we had, and maybe it was just a coincidence, but it was A, fear of inflation, and B, massive, rapid economic growth at the same time we're printing money like crazy, leading to a distrust or an additional distrust for crypto or for fiat. But if growth goes away and hyperinflation fears go away, because remember, if prices go up, even if prices went up 20% this year, like some crazy high inflation number, and then they stayed flat next year, guess what our inflation is next year? They go up 20% this year and then it's flat next year, it's 0% inflation. It's kind of weird to think about it that way. But when prices go up a lot, it's kind of hard for them to go up a lot again the next year, right? So this is why the Fed says we're not expecting to see persistent long-term inflation. Yeah, we've got big inflation now, but you don't get that year-over-year reading. And so this is something that's kind of concerning me for a lot of things. Number one, I'm concerned, well, first of all, obviously I'm bullish on tech, but I'm bullish on long shares for tech, because if growth slows down, options implied volatility can get crushed. And if options implied volatility gets crushed, your options premiums are going to get crushed. This is bad because about 20% of my portfolio right now is in options. I closed 2 options today. Obviously, as usual, I send the alerts to those of you in my Stocks and Psychology of Money group with screenshots of exactly what I do, but also the strategies underlying what I do. And I try to share as much as I can while being fair to course members, of course, on this channel as well. So look, here's the thing. The reason, I want to make this very, very clear. The reason I'm making this update is because the more reading I've been doing here, the more I continue to think to myself, Kevin, I got to get into long shares. I got to get out of options. because if markets slow down and all of a sudden we get less velocity in the stock market, the fear indices go down, there's less volume, there's less quick movements or quick changes, then option premiums go down. So even if your stocks are going up, you get volatility crushed because the implied volatility goes down, volatility crushed, boom, all of a sudden your options premiums are down and you're like, oh gosh, why did I buy options? Now I'm theta decaying and basically dying, bleeding out. Even on leaps, people are like, oh, well, leaps are the solve-all. Really? Have you calculated what would happen to your leaps if you held them for a year on a stock that traded sideways? Do it. We just did that in the course, okay? It could get ugly real fast, real fast. You could lose half of your options value or more. It's insane, even on leaps. So keep this in mind. And so personally, I see other YouTubers right now mentioning, oh, I'm going on options, I'm doing this, that. I think the options was great for 2020. And I think it's great for buying options in dips, March, April, May. But going forward at these prices, I'm not touching a single option because I think we might be in a situation where we go to slow growth and options premiums are just going to get wrecked. But not only that, I am starting to think to myself, oh my gosh, we've really been looking at this crypto dip as a crypto dip. But if growth goes away, is it possible that crypto potentially trades sideways? Doesn't have to plummet. Bitcoin doesn't have to plummet to 24,000 or 19,000 and then take the other cryptos with it. It could just trade sideways. And if that trades sideways, and then maybe recovery stocks and index funds trade sideways, or recovery stocks, some of the value ones end up trading down, and tech rotates up slowly, modestly, and we just end up in this really boring economy where maybe we don't have another market crash, we don't get stagflation because we don't have inflation, but we're in this situation where it's just slow, steady, kind of relatively boring growth, at least until the housing market blows, which I think that's a whole video topic on its own. But if you did want to get into real estate, you could always go to metkevin.com/deals, sign up for Deal Machine, and try to get deals before they hit the market, so that way you could get better pricing on your real estate. You can also learn about getting better pricing on your real estate by joining the real estate investing course link down below and use that 40% off coupon code. Although some of you probably going to be watching this tomorrow, but then again, I got to change the pricing too, and I got to go meet Patrick. But anyway, look, the bottom line of this video is very, very simple. Although it's not really simple because it comes with a big explanation, but I'm really worried that if we get slowdowns, which guaranteed we're going to have in 2022, because in 2022 we're going to be looking at 2021, I think we might see deflation and slow growth, and it's like, oh man, iPad sales are actually down 20% year over year. Oh man, they're dropping prices of used cars just to get them off the shelf because there's so many of them now. It's just, earnings are going to suck in 2022. Like, every earnings report is going to be like, are you alive? And the companies are still going to be printing massive amounts of money because they're going to have massive and record revenues. So I don't want to come across as saying tech companies or growth companies, for example, are going to have massive revenues. It's just the growth that Wall Street is so used to and has gotten so accustomed to in 2020. It's going to be gone. So I don't know. But this is something that this whole area is off limits. But what about for a YouTube video?
It doesn't even matter.
Okay, can I wrap it up?
Yeah.
Do you want to be in it?
No.
Okay, bye. Well, so anyway, now I gotta go. But yeah, those are my thoughts. Thank you very much. And folks, we'll see you in the next one. All right, I got a flight to catch now. See ya. Bye.